In this screencast, we're going to cover depreciation. Depreciation is the allocation of a plant asset's cost over its useful life. So it's the way that we spread that cost out over the period of time we expect to use the asset. In order to calculate depreciation, we need some information. First, we need the cost, and that would be the original cost of the asset plus additional costs required to prepare the asset to perform its function. For an example, if we had some installation costs in order to get the asset up and running, we would also include those in the cost. The second piece of information we need is the estimated useful life, and that's how long the company will use the asset, not necessarily the entire lifespan of the asset. So for example, if we bought a delivery van and we expected our business continues to grow, and at the end of 4 years we're going to need a bigger van. 4 years would be the estimated useful life. The total life of the van might be 8 years, and after 4 years we go and sell it to somebody else who continues to use it. The useful life for this purpose is going to be 4 years, how long we expect to use it. And again, that's an estimate that the business's management needs to make before we can move forward. The third piece of information is the estimated salvage value, and that's the value of the asset at the end of its useful life to the company. So in my example before, say we had a delivery van, we expected to use it 4 years and then go and sell it to somebody else. We would have to come up with an estimate of what it's going to be worth after the 4 years that we use it. Okay, and that would be the estimated salvage value. Important to note that numbers 2 and 3 are both estimates. They're the best estimates that we have at the time that we set this up to depreciate it. They probably won't be exact, but hopefully they'll be fairly close. Okay, so once we have that information, we can then move forward. An important amount or a number that we'll have to keep track of is the depreciable cost. And what that is, it's the cost minus the estimated salvage value. When an asset is fully depreciated, the accumulated depreciation balance should equal depreciable cost. That's all we should be depreciating on that asset, because the salvage value is what it's worth when we go to dispose of it and sell it to somebody else, and that should remain on the books. What I'd like to do is take an example of a plant asset and depreciate it using the 3 methods of depreciation discussed in the text, so you can see how each of those work with a single set of facts. So these are the facts. We have a truck that costs $41,000, estimated salvage value of $1,000, so we expect it to be worth when we're done with it. So we're going to drive it a long time, 5 years, I guess, and we're going to work it hard. The depreciable cost, $40,000 then, cost minus salvage value. The estimated useful life, 5 years, 100,000 miles, again, driving it hard. Miles driven in year 1, we're told, is 25,000 miles. Okay, so we've got 3 different methods here. Let's take a look. The first method we're going to look at is straight line. You'll see that often abbreviated S/L. And this is where an equal amount of depreciation is allocated to each year. So the calculation of depreciation expense is cost minus salvage divided by useful life. In this case, then 41 minus 1 divided by 5 gives us 8,000 a year. Easy part about straight line, 8,000 year 1, 8,000 year 2, 8,000 year 3, and so on. Okay, at the end of 5 years, it's fully depreciated. Our accumulated depreciation will equal $40,000, which is our depreciable cost. Method 2 is units of production. This is where we allocate the depreciation based on the asset's use. So you can use this method where you have an asset that is like a piece of manufacturing equipment where we expect it will produce so many pieces that we produce on our production line, or it's a vehicle that we drive so many miles. It has to have a measurable unit of measurement for us to be able to do this. So it is kind of a specialized method, but it's very accurate in that if you use an asset a great deal one year and not so much the next, your depreciation expense will follow that pattern. So you'll have high depreciation expense in the first year. It'll be lower in the second year because you didn't use it as much. So in our example here, we're also given that the estimated useful life is 100,000 miles on this vehicle. So we've got a 2-step process for unit of production depreciation. First is to calculate the depreciation per unit. That's calculated as cost minus salvage divided by the total useful life in miles. So a lot of similarity to the straight line calculation. We're just using life in miles instead of life in years. Using the given amounts above, 41,000 minus 1,000 divided by 100,000 gets us to 40 cents a mile. So for every mile that we drive this truck, we're going to depreciate it 40 cents a mile. On to step 2. This is where we calculate the depreciation expense. So we're going to take the depreciation per unit determined in step 1, which is the 40 cents, times the current year usage, which was given up here at 25,000 miles. So 40 cents times 25,000 miles gets me to $10,000 of depreciation expense in year 1. Some important notes here. Years 2 through 5 will vary based on the actual miles driven each year. You may not drive it any next year in year 2, and your depreciation expense will be 0. Okay, then you start driving it again in year 3, you would calculate your depreciation expense. So it's volume driven. Once 100,000 miles total are driven, you stop depreciating the asset. You can keep using it as long as it's cost effective, even if it's no longer depreciating. But again, all we can depreciate is up to the depreciable cost. And that's based on 100,000 miles of usage. Okay, so once we reach accumulated depreciation of 40,000, no more depreciation for that asset, even though we may continue to use it. The third method we're going to look at is the double declining balance method. This is an accelerated method that allocates more expense at the beginning of the asset's life. And it's actually a 3-step process. The first step, we determine the straight line rate, and that is 100% divided by the useful life in years. If you recall from up here, we're told that our estimated useful life is 5 years. So we take 100% divided by 5, 20% is our straight line rate. So if we were depreciating this on a straight line method, we would depreciate 20% per year. Step 2, we determine the double declining balance rate. That's 2 times the straight line rate. So it's 20% times 2, which is 40%. And then step 3 is where we calculate the depreciation expense. That's double declining balance rate of 40% in our example times the beginning book value. Okay, remember the book value is cost minus accumulated depreciation. And we're going to calculate 3 years for this method to better illustrate how it works. So year 1, 40% times 41,000. So for year 1, we don't have any accumulated depreciation. So our book value is cost to begin with. 40% times 41,000, 16,400. Then we can calculate our end of the year book value. 41,000 minus 16,400 is 24,600. Okay, that's the net value left on the books. End of year book value equals beginning of year book value for year 2. That's why I noted that up here. So for year 2, our depreciation is again the 40%. This is used as a constant, times the 24,600 equals 9840. To come up with my year 2 ending book value, I take my 24,600 minus the 98,400 additional accumulated to come up with a book value of 14,760. That is then used over here for year 3 to calculate depreciation. 40% times the 14,760 gives me 5,904. And my book value at the end of year 3 is 8856. So I could continue on depreciating. A couple of notes on double declining. For this method, you don't subtract salvage value for the above calculations. You notice we're starting off with the book value, which is 41,000. We haven't adjusted for salvage. But you can't depreciate below salvage. So you have to keep an eye so you don't depreciate too much. So you need to watch the end of the year book value to ensure it doesn't go below 1,000 salvage. If the depreciation calculation goes below salvage, you need to reduce the depreciation expense for that year. And I've done an example down here. So this is an independent example. Beginning of year book value is 1,300 with a 5-year useful life and 1,000 salvage value. So step 1, our straight line rate's 20%. Step 2, our double declining rate is 40%. So step 3, we'd be taking 40% times the 1300 book value equals 520. But this would take book value below the 1000 salvage value. So we have to back up, and we can only depreciate what's remaining, the 300, to get us to salvage value. Okay, so you can't over depreciate it. You need to stop at salvage value, but that has to be kind of a manual backstop because the salvage value is not taken out up here. And I reinforce that because that's something that students sometimes miss when they're doing double declining balance. Okay, I hope that's been helpful, and I'll see you next time.